Robinhood just gave millions of users the ability to let artificial intelligence buy and sell stocks without human approval. Within the first week, over 200,000 people activated this feature. But here's what almost nobody is talking about. 3 users have already reported losses exceeding $10,000 in less than 48 hours. The promise is simple. Sit back while AI grows your wealth. The reality? It's complicated and potentially dangerous if you don't understand what's actually happening behind the scenes. Let's start with what Robinhood's AI agent actually does. Unlike traditional robo-advisors that rebalance your portfolio quarterly, this system makes real-time trading decisions based on market data, news sentiment, and patterns it identifies across millions of data points every second. You set parameters like risk tolerance and investment goals. Then the AI executes trades automatically. No notifications, no approvals, just autonomous decision-making with your money. The technology uses machine learning models trained on decades of market data. It can process information faster than any human and theoretically spot opportunities we'd miss. Robinhood claims their internal testing showed returns 12% higher than the S&P 500 over a simulated 6-month period. Sounds incredible, right? But simulation and reality are very different animals. Here's the first major risk. AI models are only as good as their training data. Every AI trading system ever built has been trained primarily on bull market data because that's most of financial history. But markets don't always go up. During the 2020 COVID crash, multiple AI trading funds experienced catastrophic failures because their models had never seen that pattern before. One prominent AI hedge fund lost 73% in 3 weeks. Human traders lost money too, but they could adapt. The AI just kept executing its flawed logic. The second risk is something called overfitting. AI models can become so good at predicting past data that they fail miserably with new data. Imagine teaching someone to drive by, only showing them sunny days on empty roads. The first time it rains or traffic appears, disaster strikes. AI trading systems often perform brilliantly in backtesting, but struggle in live markets because past patterns don't always repeat. Now let's talk about costs. Robinhood markets this as free, but nothing is truly free. The AI agent makes significantly more trades than a human investor typically would. Each trade creates a taxable event if you're using a standard brokerage account. If the AI makes 200 trades in a year and you're profitable, you could face massive short-term capital gains taxes up to 37% federally. A human buy and hold investor pays just 15 to 20% on long-term gains. That difference can destroy your actual returns. There's also the hidden cost of execution. Robinhood makes money through payment for order flow, meaning they route your trades to market makers who profit from the bid-ask spread. More trades equal more profit for Robinhood and their partners. When you make 1 trade per month, this barely matters. When AI makes 5 trades per day, those tiny spreads compound into real money, leaving your account. So when does AI trading actually make sense? There are legitimate use cases. If you have a large portfolio over $500,000 and want to implement complex strategies like tax loss harvesting, volatility arbitrage, or sector rotation, AI can execute these faster and more consistently than manual trading. Professional investors use algorithmic trading extensively for good reason. AI also makes sense if you're investing in highly efficient markets where speed matters. Currency trading and certain commodity markets move on microsecond timescales where human reaction time is a genuine disadvantage. But for the average person investing in stocks for retirement, the evidence suggests simple index fund investing outperforms most AI systems after accounting for taxes and fees. Here's a critical question nobody at Robinhood wants you to ask. If their AI is so profitable, why are they giving it to retail investors instead of using it themselves to print infinite money? Think about that. When Goldman Sachs develops profitable trading algorithms, they guard them like nuclear codes and use them for proprietary trading. They don't offer them free to the public. The answer is probably that Robinhood's AI is good enough to generate engagement and trading volume, which makes them money, but not so good that it consistently beats simple strategies available to everyone. It's a product designed to benefit Robinhood first, you second. That said, AI trading technology is improving rapidly. 5 years from now, these systems will likely be significantly more sophisticated. The question is whether you want to be an early adopter with real money at stake, or wait until the technology matures and proves itself with audited long-term performance data. If you do decide to try AI trading, here are non-negotiable rules. First, never allocate more than 10% of your investable assets. Treat it as experimental capital you can afford to lose entirely. Second, use a tax-advantaged account like a Roth IRA to avoid the tax nightmare of frequent trading. Third, monitor it weekly at minimum. Autonomous doesn't mean ignore it completely. Fourth, have a clear exit plan. Define in advance what losses or behaviors would make you shut it down. The financial industry has a long history of marketing complex products that benefit the house more than the player. Variable annuities, structured notes, leveraged ETFs, all marketed as sophisticated tools for better returns, all resulting in underperformance for most users. AI trading might be different, but the burden of proof is on the technology, not on you to trust it blindly. Here's what to do next. Before activating any AI trading feature, calculate exactly how much you'd pay in taxes if the system made 100 trades this year with your current portfolio size. Run that number, then compare it to what you'd earn by simply putting that money in an S&P 500 index fund. If the math works in AI's favor, even after taxes and assuming average performance, maybe it's worth testing with a small amount. If not, you have your answer. Drop a comment with your portfolio size and whether you'd trust AI to trade it. The answers might surprise you and help others make smarter decisions.